The biggest and hardest problem in finance is personal income retirement planning, according to William Sharpe. Wow. Now, why would he say that? I would say that there are at least 5 major reasons, and we're going to cover each of those briefly here now. 5 major reasons why I think William Sharpe has this to say about retirement income planning being the hardest and nastiest problem in finance. The first major challenge is market volatility. Now, everyone maybe remembers or has heard of the 2008 crash, where the Dow Jones dropped over 50% in 17 months, eroding savings for millions of Americans and really around the world. And the market is just something you can't predict or control. A major market crash in the 5 years before or the 5 years after you retire would have a devastating impact on how much you would actually be able to live on in your retirement. So, for example, if you see a market drop of just 20% in the few years before you retire or the 5 to 10 years after you retire, that could dramatically reduce how much you're able to pull out as a stream of income in retirement. The second major challenge is a decline of the pension plan. It used to be just part of the nationwide ethos that you're going to get a pension if you have a corporate job. But now, fewer than 15% of workers today have access to a company pension, guaranteeing them an income for life. What happened to it? Well, it was replaced. It was replaced with DIY, do-it-yourself plans. No guarantees, with, meanwhile, full exposure to the Wall Street casinos. Number 3, inflation risk. The inflation has been soaring lately, but historically, inflation has averaged 3% a year. That's 30 years of inflation, though, over your retirement, right? So 3% doesn't sound like a lot, but over 30 years, that actually cuts your purchasing power in half. So, a lot of people think, well, the answer to this is invest in the market. And sure, you can get a great return sometimes in the stock market and get a great yield and hopefully beat inflation. But the question then is, let's say you built up, $1 million in your 401k. You're a 401k millionaire. Congratulations. The question then is, at retirement time, how can you safely withdraw money out of that 401k without running out of money? Is it $1 million all at once? Just rip it out of there, call it good? Maybe it's just a few cents, few pennies a month to be safe. Maybe it's just enough for your daily groceries or avocado toast habit. Or is the answer, nobody knows? Well, that's the answer, right? The only true answer is nobody knows. William Sharpe agrees that it's the hardest and nastiest problem in finance. No one knows how much you can safely withdraw from that 401k bag that you have there. The 4% rule used to be the law of the land. It used to be sort of a rule of thumb that you could take 4% of your balance out each year. And it was considered previously a safe withdrawal rate. Now, these days, folks are saying 2.8%, 3% is more likely the best way to go. But even that only has a 90% success rate. So if you have a 401k and you got $1 million in your 401k, that's about $30,000 a year that you could safely pull out of your 401k. So my point is, even if you get a great rate of return in the markets, the best research says you shouldn't pull more than about 3% of your money out each year from your market-based investments. This is a very difficult thing to try to solve for. Before we get to the 5th challenge, I want to ask you a question. What percentage of U.S. 65-year-olds will live to be 90 years old? What percentage of U.S. 65-year-olds will live to be 90? The answer? 25% of men and 30% of women age 65 today are going to live to be 90. So that's the 5th challenge, longevity, living too long. People who are now today 65, there's a 50% chance as a married couple that one of the members of that household will live past age 90, and a 10% chance that one of the husband or wife is going to make it past age 95. This creates a ton of financial uncertainty. This idea of possibly living even to 100 or longer can have a dramatic impact on providing for yourself, especially in those final years when you're the most vulnerable. And a lot of people misunderstand this. They think that they are going to make it maybe only as long as their parents, but actually, your parental age at death, according to a 2023 study, is a very poor predictor of your own mortality. And this is the problem. Once you are on a glide path in retirement, once you've spent money and it's gone, it's hard to undo it. Maybe you took too much out of your retirement accounts early on and you run out of money when you're the most vulnerable. Or possibly you were very stingy in the early years of your retirement and you lived in voluntary poverty, fearing you'll have nothing to live on. This again makes sure that somebody else besides you get all your hard-earned savings. And that's kind of an interesting idea, right? That you would underspend, and that's a problem, that you live in voluntary poverty. So here's another question for you. What percentage of money do people with $500,000 at retirement spend down in 20 years or by the time they die? Think about that for a minute. You might think maybe most of it, right? That's 20 years. Maybe majority of the 500 grand is spent after 20 years. Well, the answer might surprise you. The median, meaning the middle of those who spent that money down with those who have over 500 grand, only spent down 11.8% of their assets, meaning only 12% of their money was spent after 20 years. This means that many people are underspending what little they've been able to scratch together. So again, $500,000 at retirement, and after 20 years, you've only spent down 12% of your money. Retirees with less than 200 grand saved have only spent 25% of their assets in 18 years. So this means that many people are living with missed opportunities. They're not getting to enjoy that money that they worked so hard to accumulate. How many vacations did they have to skip? Grandkids they couldn't give to college and so forth. But regardless, whether you spent too much or just did not spend enough out of your savings, you're going to live, unfortunately, with a traditional retirement strategy. You'll live with fear and worry instead of being able to be carefree after putting your nose to the grindstone for all those years. This is why I think annuities, of all things in the financial universe, solve the guesswork. They solve the problem of all the 5 major challenges that typical retirement planning presents.